Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital, and joining me today, the man himself, Mr. Michael Becker.
Hey, Paul.
The governor, the mayor himself.
We got to pick one.
Today we got to pick one because we got two smart guys in the room today. So tell me, Michael, how is everything going over at SPI?
Things are good. We're hopefully about to break our cold streak and hopefully get a couple deals tied up. So I'll be hopefully stay tuned. We'll get some more out once we get a little further down the road.
And you know Michael and his group at SPI, they own over 7,000 or bought 7,000 units, and they've sold a couple, and you guys are doing awful well, I think.
Yeah. So what's going on in the Old Capital world? Anything people should know about?
All right. Don't forget March 30th, the Hoops for Homelessness over at SMU, Southern Methodist University. We have a number of teams that are going to be playing in a charity basketball game that we are sponsoring, hopefully to help children and young adults that are in special need from parents that don't want to or cannot take care of them. So we're pounding the table for Hoops for Homelessness. Go to the oldcapitalpodcast.com, oldcapitalpodcast.com website to participate and donate some money to that worthwhile cause. Second thing, the good doctor is in town on April 3rd. Dr. Mark Dotzer coming in, Texas A&M chief real estate economist that just retired. But he is the guy that everyone in the mortgage industry, the investing industry, individuals that want to know what's going on, institutions that want to know what's going on, they want to listen to him. And so I think it'd probably be a good idea for everybody to come to that event on April the 3rd over the Grapevine Convention Center. Mike, what's your take on that?
Yeah, just get your tickets if you go to the same website, which is oldcapitalpodcast.com. You can fill that out. It's free for you to attend. We just need to know how big of a room to get. So you do need to register and sign up ahead of time so we know how big of a room Paul's got to book. And like I said a few times before, the first time I got to go see Dr. Dotzer. It cost us $100. So here, Paul's going to subsidize that for everybody. So make sure you take him up on his generosity because it's not only good information, it's very well done. He's a very entertaining presenter, as well as there'll be 400 to 500 of our closest friends you can come out and network with. And if you know, we said this many times, this is not a business you can do behind your desk or at home. You got to get out, go get networked, go to events, go to conferences, meet people. And this is a good example of that. So certainly come out. And Paul, speaking of that, I think that maybe is a good segue into what we're going to talk about today on the podcast. Absolutely.
So in the podcast today, we have a friend of the podcast and a friend of ours, JC Castillo, that comes in from San Jose, California. As you know, JC owns a bunch of apartment buildings in the Dallas-Fort Worth area. He's been in this marketplace for a long period of time, probably longer than most people have been investing in the Dallas-Fort Worth, Texas marketplace. He comes in from San Jose. He's formerly of the high-tech industry, and he's used some of his high-tech skills to help him find a way to buy multifamily properties. So, JC, thanks for coming in. We appreciate your time.
Paulie, thanks for having me, man. Glad to be here.
So I wanted JC to come in because we're going to talk about two different things. One, JC just recently closed on a transaction here in the Dallas-Fort Worth area, so I want him to talk a little bit about that, how he structured it, how he found it, how long it took to close, some of the basic questions that investors like you want to find out to give you a little bit more power, strength when you're negotiating your own stuff. And the second thing, and JC's great at this, JC likes to go to these conferences. And so JC went to a multifamily conference just recently, I think last weekend, and he came to Dallas to do another conference here called the IMN conference that he participated in here in the Dallas. And so he flew in to take a look at some of his properties, also attended a conference. We grabbed him by the shirt tail, said, hey, come on in. I want to find out a little bit more about this conference that you went to last weekend, and I want to find out a little bit more about this conference that you currently are at today and yesterday, and try to help us take some good nuggets out of both conferences so you can kind of give everybody a little bit of inside information about what's going on and what you're seeing. So, JC, again, welcome to the podcast.
Thanks a lot, Paul. I appreciate it.
So I think I'm going to turn it over to the Grand Inquisitor, Mr. Michael Becker, but first thing I want to kind of lead off is let's get into learning more about your last transaction.
Yeah, maybe just kind of talk high level. Tell us a little bit about kind of where the property is located and how many units and the vintage and all that good stuff for the most recent acquisition for the multifamily group.
Yeah, absolutely. I think, I've had a little bit of good luck lately. Maybe it rubbed off for me with Mike Becker here, but I've had some swings and misses for the last several months on deals that we just weren't up to par with the pricing at. But we finally found a deal that penciled out, and this deal is in Southwest Dallas. I actually was initially not too excited about the location of the property, if I have to be honest, but we obviously absolutely love the DFW market. Been here for about 12 years, and so if we're going to be doing deals, it's probably going to be here for a lot longer. And what I always do with my properties is I go to what I call my tribal council for advice. So if I've got a deal that I'm not sure, I kind of know the market out here, been here long enough, but, I always go to like example with Paul or some of my other trusted advisors. And I say, hey, look, I got a property here. It pencils out, the numbers look good, but I'm just not sure about the location. Do you think you could take a drive by, go walk the property, look at the neighborhood, tell me what you think? A guy like Paul here, for example, has probably driven more deals than most anybody else in this market. So, Paul drove the deal. A couple other people did, big thumbs up. And so that really told me a lot about the property, because if my tribal council gives me sort of the thumbs up, then I have a pretty good feeling that this is going to be a winner for us, right?
So tell a little bit about the deal. So how what's the vintage and how many units and all that good stuff going?
Yeah,
what's the basic,
strategy? It's basically 1983 construction, typical, let's say B minus sort of B asset. It's got pitch roofs. It's got really nice landscaping. It's kind of tucked away from a lot of the other competing properties in that micro market. Really, what I really liked about this deal, the story in the deal, is the current ownership group, or the owners that had it, owned it for, over 20 years and had been almost completely untouched. So we had an opportunity to come in, and we had multiple ways to add value right off the bat. They weren't even charging back for water, for example, and the market rents were not where they need to be. And we knew that we could really turn this into something special with a little bit of TLC. But what put it over the top was there's a lot of things about these deals, if you drive enough of them, where if you've got the real great mature landscaping, and it's got the right sort of feel, a peaceful feel, family feel, those are sort of things that you can't necessarily recreate with putting a couple dollars into the units. And it already had all that. So, if you fix it up on the cosmetic side, which we're really good at, I knew you put those two things together and we've got a real winner. And so for us, that's what put this deal over the top.
But you almost did not get it. So let's kind of go back and have people understand.
Well, I did my best to sort of step in dog poop along the way. And in spite of that, I was able to clean my shoe off and still make a run at the property.
So when's the first time you were aware of this deal, and then when did you actually close on it?
The time to being first aware of it was about 6 months until the time that we closed it. And, we've built a pretty solid reputation here in DFW for guys that, kind of do good quality deals. And so this deal came to us completely off market. The seller had signed a listing agreement with a reputable broker shop out here, and we got a call about it. And the next day they called us back and said, "Hey, the seller changed their mind. They got two other partners that aren't sure if they're ready to sell yet, so that it's on hold." And so we had already started looking at the deal. So we finished our underwriting, and the numbers looked good. And so we decided that we were going to stay on it and see if we could scoop something up before it went to market. In the meantime, these owners were trying to figure out their personal stuff to sell the property. And so, every 2 weeks or so, I would make a little note in my calendar to check in with the realtor. And it took us until Thanksgiving time, right before Thanksgiving, checked in again, finally a little bit of break in the weather, and they said they were ready to sell it.
So I think that's an important thing, maybe kind of just reconfirm here. So you, for about six months, every week, every other week, you're making yourself a note, calling the broker, and it's no change. And he's like, all right, put in a note. 2 weeks later, I'm going to call him, and it's no change. And eventually one day you called, and it's like, oh, I just talked to the seller, and we're thinking about there's a change, right? So persistence, follow through, being very consistent. I think those are certainly some attributes, and not giving up. Those are definitely some good takeaways from what you just said to people that are out there. We'll talk a little bit more about the conference here in a minute, but I was there yesterday with JC in the morning, and what one of the guys was saying is like, I'm having a hard time finding deals, and what do you do to get your deals? And I'm like, you just got to do more. And that's the answer. Just more of everything is always the answer. So go ahead. I'm breaking your concentration.
No, I think it's spot on. I mean, I think people need to understand that, it's not always about, deals these days are hard never to find. So you've got to get creative about how you can get your unfair mind share and capture the deals. And I've always thought about deals as more of a rifle shot approach than a buckshot. So it doesn't mean that we're not underwriting lots of deals, but it also means that we're throwing most deals off the table almost immediately because we don't like the location or we don't like the asset type. We're not doing C stuff anymore. So a lot of deals kind of fall off the plate immediately. But the ones that we spend time on, if we really like a deal, we're going to really strategically figure out how we can take it down. And we're going to pull out all the stops we can to strategically go rifle shot that deal and bring it down. Now, we don't always kill the elephant, but you'd be surprised with a rifle shot approach. You increase your odds greatly. For example, strategically, we knew this was the right fit. So making a note to check in with the realtor every 2 weeks with a text or phone call was no sweat off my back, really. But ultimately, it made a huge difference and it captured the deal for us. More importantly, off market, which was great. It never went to market.
How long was it between this deal and the last deal? How much time elapsed between buying properties for you?
Yeah, it had been since March of 2017.
And then when you closed this one?
And we closed this one on Jan 31st.
That's a long time. Let's
see.
So
that's almost 2 years.
Almost 2 years.
Right?
And then, so how many deals do you think you underwrote and looked at? And so, I mean, you obviously, like you said, you disqualify a lot of properties pretty quickly. So how many properties that came across your desk? How many did you actually spend time underwriting, touring, et cetera? If you could maybe ballpark that.
I mean, I bet you Eric Hardy, my VP of Capital Funding and Acquisitions, will probably give you a really heartfelt answer to that. But I would say it's probably going to be in the, under 100, but certainly not much less than 100 deals underwritten at the initial level. And then going hard, spending, we're talking like 2-3 weeks, probably 15, 20 deals.
Yeah. To get one 18 months later.
Yeah.
Yeah. So I just want to make sure that when people get frustrated, this is sometimes what it takes to get a deal done, and persistence. And, that I think is a testament to JC. They stay disciplined and had tenacity, stay after it, not give up, and eventually got rewarded. So
let's kind of go through my checklist of 20 questions. Why was the seller selling?
The seller was selling because two of the owners wanted out of the deal. They'd owned it for a very long time, and they had to convince their other two partners to get out of the deal.
And the property itself is how many doors?
It's 192 units.
So it's a big size property. It was built in the mid 80s or so, individually metered, pitched roof. Is there two pools or one pool on the property?
It's got two pools at the property. Yep.
And it has its own third party property management company that overseed it. That was owned by the seller.
That's right.
And then you come in, you've put your own third party property management company in.
That's correct.
Were you able to retain, or did you want to retain some of the people from the seller to you?
We always like to retain, if we can, the great people at the property, especially the maintenance guys. In my opinion, maintenance guys are probably a little bit even more important than some of the on-site staff.
What was the occupancy of the property when you guys bought it?
We were right around 96% occupied. So
the property, you've owned it for a couple months now. Where's the occupancy right now?
Well, we're probably around 92, 93%. So we have seen a few move-outs, which is typical when you take over a deal. People that I think we bought it on a Friday. By Monday, we were ripping off all the roofs.
Yeah, let's talk a little bit about the rehab dollars that you put in, because that's an important piece of the deal. Is that this is a stabilized property, but also had a value-added component to it. And what were some of the value-added pieces you put onto the property?
Yeah, so we're putting about a $1.7 million into the property.
Wow.
About $1 million of that is going to be kind of your sticks and bricks, right? We'll do we'll replace all the roofs. We'll do a paint job. We're doing siding replacement for a pretty significant amount of the property. We're doing a rebrand, so we're doing new signage. We're going to remodel the community center, leasing office. We're going to put some pool furniture, around the pool. We're going to install a dog park, make it pet friendly, which it wasn't before. For two reasons that's important. Number one is not just about the money, but most good families these days have pets. And so if you don't accept pets, you're turning away a certain percentage of the good quality prospects that you can have in the seats. And then obviously we get rental money from, initial non-refundable deposits, and also, monthly pet rent if we do that.
So why new signage? Are you rebranding the property?
So we're going to rebrand the property. And today it's called Smith Creek Apartments. And what we really want to do is sort of capture more of a modern flavor to the property. So it's got a little creek that runs by it called 5 Mile Creek.
Okay.
And so, I came up with the name Arroya, Aroya Apartments, because arroyo in Spanish is a creek. And so I wanted sort of that modern, twist on it. So Arroyo Apartments is what we're going to rebrand it. So we got a cool logo, and that's where we're going with the rebrand.
And the property itself needed a new roof, and you knew that right up front because you had some inspectors take a look at it.
We did.
And how bad was the roof, and was there any leaks before you took off the roof?
There was definitely past its useful life. We kind of figured that out. And actually, when we first got together with the ownership group, because they agreed to talk with us about the deal before they agreed to sell it to us, they actually proactively mentioned, they go, look, have you factored in the fact that it's going to need a new roof in your offer price? We said, yep, we know it, and our offer accounts for replacing the roof.
What type of roof did you put onto it, and how much did it cost?
It was a 30-year roof, and I think we spent around $280,000 if I had to guess.
Did you take the wood decking off, or were you able
So
to keep
usually what happens when you replace these roofs is you're going to have some percentage of rotted decking. So what you want to do when you're getting a bid from the roofer is get the price for the roof, but also get a price on a per sheet of plywood basis for labor and materials to install it. And so what you do is every building, you have the roofer go through and say, look, this building needed 30 new pieces of rotted out decking, and you've already agreed on the price. Let's say it's $35 or something per sheet. Then before you even get into contract with the guy, that because they could never tell you up front how much decking they got to replace, but you at least as an operator want to know how much you're going to have to pay per sheet. So you know that when there's change orders, you know that they can't just come back to you and say, oh, guess what? It's $200 a sheet, and now suddenly that $275,000 roof turns into a $350,000 roof. You got to be real careful there.
Are you painting the property too?
We are. We're going to repaint the property. It's got a lot of brick on it with a natural good color, so we're not going to touch that, but we're going to touch the siding and the stucco, and we're also going to put some cedar wood coverings around all the patios.
And marketing of the property, how do people find this property? How do you reach out to them to tell them that there's units available?
It didn't really have a very good marketing program prior to taking it over, so we've got a nice new website. We've got the ability to advertise on different channels.
Tell me what the website's address is.
The apartment address, you go to Arroyo, AROYA, Dallas.com. So ArroyoDallas.com. You can check out the website. It's got some pictures of the current property, but obviously as we've gotten this thing remodeled, we'll put some new pictures
Did
up.
you guys build it yourself, or did you have a third party go out and build
So
it for you?
the website, actually, the packaging or the template for the website comes through the property management software partner. So they've got a template. We give them all the information. They kind of build it out with the template, and we load it up that way.
That's kind of the easiest way, isn't it?
Yeah, you don't want to be building your own websites with these things. You want to kind of go with a software property management company or a property management software provider that already gives you the templates. And all these guys like Yardi, RealPage, AppFolio, et cetera, they're going to have those sorts of things for you.
And what type of financing did you choose on this, and why did you choose that financing, and what's your game plan of how long you're a long-term owner, so what's the kind
well,
of game plan?
you know, my principle is go long, not short. So we are long-term players. We don't like to take chances. We're big believers in risk-adjusted returns, not raw returns. So we wanted to put fixed debt, Fannie Mae agency debt right away. We put a 12-year loan. We did something unique. We did a streamlined rate lock with good old Doherty Mortgage, and Fritz was fantastic. I highly recommend your listeners talk to him. But we basically locked almost the same day that we actually signed the contract on the property. And so we were very, very careful to limit our downside by locking the rate ahead of time so that we don't get in a situation where rates could have spiked during the purchase contract, and that would have killed us, right?
So before you went to raise your capital, you had certainty of rate and generally certainty of, for the most part, of proceeds the day you locked. Is that right?
That's correct.
So what's kind of the downside by doing that? Because
the big downside is that when you rate lock, you got to put down a deposit, rate lock deposit. So that's typically going to be 2% of the loan proceeds. So
if you can't raise the money, then
so if you're giving a check to $200,000 to the agency, to the DUS, and you're not able to close that deal, that money goes bye-bye. So, there is definitely a trade-off on the risk side. The other downside is that it's kind of obvious, but if you streamline and rate lock ahead of time, if rates actually go down but before you close, then you potentially could have saved yourself a couple bips by rate locking later. But the same thing holds true. You could also go up. So, that part you kind of don't know.
Yeah, but I found that to be helpful. We've done that a few times where you take out the risk and the rates are going to do what they're going to do, but at least if it works for your business plan and your business model that at that moment in time, then, you're good to go and you have certainty of execution from that standpoint, but just make sure you raise capital before you do it. Otherwise, you're kind of SOL. So,
yeah.
Anything else you want to add on Smith Creek or the Arroyo apartments before we kind of pivot to the other part of the podcast?
The only thing I would say about these deals to your listeners is, it's not just about getting a great deal. It's about executing on the deal. A lot of people can get great deals, even though they're hard to come by. You can get a great deal, but depending on how you execute, you can turn it from a great deal into a bad deal or a mediocre deal. So make sure that you've got your team in place that's going to take you from the minute that you take over the property to repositioning the asset, to operating the asset. If you're looking for third-party management, make sure you do your homework on who to pick. The right partners especially the right property management company is going to be probably the most important piece to determine whether you're going to be successful, especially in this environment where the yields are getting lower and lower and the margin for error is shrinking. I can't stress enough how big of a disaster it could be if you partner with the wrong people or you don't have your team in place. Like I said, you can take a great deal and you can make it into kind of a shit show, right?
Yeah. So you went out. Well, thanks for that first off, and then it was good information. Hopefully, people will take some lessons from tenacity, persistence, follow through. Analyzing a lot of deals, being disciplined about it. Those are all things that I think JC kind of just explained through his little story on the deal story of the Smith Creek Apartments. It's not an easy business. Always, what I like about it is very simple. It's not always easy. So, like you said, you got to fight through a lot of stuff. And today's certainly harder today than what it was a few years ago. But it sounds like JC found a deal that not only had rental rate upside as well as, upside through billing back water, which sounds like 2013 to me again. I'm sure he didn't pay an 8.5 cap like he would have in 2013, unfortunately. But he's kind of got the 1-2 punch when it comes to forcing value, because a dollar in incomes doesn't really matter at the end of the day, whether that comes from rent or water bill back or, application fees or whatever he's going to be able to charge more for at the property. So you went out to San Diego a week and a half ago, and you had basically a little conference with a bunch of other apartment owners from all over the country. So maybe we thought we'd kind of have you maybe give a few takeaways from what you kind of observed and learned at that thing, and then maybe we could talk a little bit more about the IMN conference, which I got to go to for just a very brief period of time the last couple of days. So maybe, I don't know, Paul, do you want anything specific you want to ask JC?
Well, I want to hear all the nuggets. I mean, I want you to give us a book report. So remember when you were in elementary school and your teacher said, read this book, and then I want you to put a book report on my desk tomorrow morning. I want you to take out some of the nuggets on these 2 meetings, and we'll kind of handle each meeting by itself. I want to hear some of these golden nuggets that you pulled out of it from other operators that, just like Mike said, that were around the table, that you could help people that maybe are not that level, but just give them some golden nuggets on your book report. So let's kind of talk a little bit about the first idea. And I think one of the things that we talked about just right before the podcast is having social media. Talk a little bit about that.
Yeah, I think, talk about social media. The other thing I want to do before I get into that is I want to up level a little bit and just say that, Mike, you and I talked about it, right, is that we all get super busy with the minutia of running our companies, and, we've done really well for ourselves. And so it's pretty easy to get caught up in the rat hole of your office, kind of focus on all the blocking and tackling. But you really got to do your best to kind of get out there and network and go to these things, because when you do, you're always learning things that you just didn't think about and looking at it from different perspectives and meeting different people that are going to help you do your next deal that you don't even know yet. So make sure if you're out there listening to this podcast that you do whatever it takes to get out there to your local networking meetings, go to national events, go to these things, meet people, and take notes at these things, because I guarantee you that you're going to take a couple of key pieces of information away. They're going to change the way you do your business. It's going to help you grow, actually. That's kind of the first thing I would say to your listeners.
Let's talk about social media and how that impacts you having the ability to raise money.
Yeah, I think, social media is really important. I was at a conference where we sat down with about 40 or so multifamily owners of varying levels of success. I think one of the key takeaways that I had from this event was that, we raise a lot of our money out of the Silicon Valley. That's where we're based. And, we've got a lot of connections to technology capital. And a lot of our capital is, let's say 45 to 55 to 60 years of age. So they're sort of a different generation of capital partners. But you got a lot of these high net worth guys that are, at least in the Silicon Valley, they're, starting, companies like Twitter and Uber and all these companies that you'd know of that are just a different type of capital partner. And they associate a lot better with social media, and they associate a lot better with videos versus write-ups and whatnot. And they've got a lot less of an attention span. And so what I've really been looking into for our company, and one of the things that I enjoyed at the meeting, was learning about the ways that the people are using social media to attract and educate a younger demographic of high net worth individuals that are looking to passively invest in real estate deals, but that don't necessarily associate or do well with the traditional methods of sort of interacting with the sponsors or the guys that are putting these projects together. So, for example, our company, how we're able to leverage social media, things like LinkedIn, things like Facebook, things like, what you guys are doing is great with the podcast, but these are ways to connect with a generation of up and coming investors that are really not going to associate well with your traditional methods of reaching out to the listeners. So these guys and girls are looking for education without selling, right? They want to go to a YouTube channel that you create, and they want to watch videos on what are the best ways to invest in apartment properties. They don't want you to tell them how to, sign up for $9.99 to your thing. What they want is education. And by doing that, what you do is you build yourself up as a thought leader and somebody that gives away this education for free. And at some point, when these people are ready to invest and work with somebody on a deal, it's going to sell itself. Your education is going to pay off in the sense that you're going to give them enough of a virtual relationship with them that they're going to come back to you on the back end and say, hey, look, you know what? I'm ready to invest. I was watching all your videos, and I like how you operate, how you think. I'd actually like to sit down with you and talk to you about how I put my money in. And so by doing that, you've never sold them, but actually by educating, they've come to you and they've invested with you. So this was one of the key takeaways that I got from our conference.
So I absolutely love that, because you can't ask people for money until they know what the hell you do. So maybe you have an hour of content, not that you're selling them to get into your deal, because you can't do that. That's illegal to try to do that. But if you can educate them on some of the basics, how do you create NOI? How do you look for these properties? What are we looking for? What property type? What class? What's the difference between a yield play and a value-added play? What is the time horizons on these transactions? What are we looking for rehab? I think you do like 4 or 5 minute YouTube informational pieces just to capture their attention and see you as the ability to answer those questions as an educator instead of a promoter in the deal. I think that brings a lot of confidence. Mike, what do you think?
No, I think that's good. I think having a thought leadership platform, kind of similar to what we have here on our podcast, but you do it in your own way and put it out there. And I think that's a good way, because people do business with people they know, like, and trust. And if they don't like, know, or trust you, they're not going to give you the capital. That's for sure. So
idea number 2, how do you do more research in some of these submarkets? Talk a little bit about that, and because we're experts of slicing and dicing the numbers and try to create the NOI, but we don't usually do a pretty good job of making decisions of cities, markets, and then submarkets. Yeah, I mean, I as part of this conference, I was lucky to sit down in front of a presentation that talked about exactly that. So, as you rightly pointed out, we're experts, and we've got our underwriting models to take a property set of financials and pick it apart and go, is this property from a financial perspective going to be the right fit for us? And we say yes or no. But I think what a lot of syndicators or sponsor companies, groups don't do as good of a job at is, how do I take a city or a metro and how do I determine whether that actually meets my investment criteria from a holistic perspective before I even look at a property? And I'll take it a step further, is how do I actually dive into the micro market? Because as you guys know, you literally go from like 2 or 3 blocks one way or the other based on a micro market, and could change whether you would actually invest there. And so how do I get to that neighborhood level, and how do I have a structured approach to basically determining whether that micro market, that neighborhood level area is an area that is going to meet my criteria for investing? And if it does meet it, then great. I go underwrite the property, look at the financials, do my stuff there. But if it doesn't meet, I sort of throw that one in the trash bucket, move to the next one. So doing that does 2 things. 1, it gives you the ability to be structured about where you invest. But 2, it actually helps you to do a better job of underwriting deals faster, because the more you can throw in the trash, you can focus on the ones that are going to really benefit you. Where do they get the information from for the data that you should be looking at? Is it CoStar data? Is it just data that maybe some of the other companies have? Did he mention any data where we can do some research into those markets and submarkets? Yeah, there's some really specific, great websites and whatnot that he mentioned. This particular person, off the top of my head, I don't have it right in front of me. But what I would say is, a lot of this stuff is like readily accessible, not through CoStar, not through a paid service. You can literally go to
free websites that can give you all this information. And CoStar is great, but CoStar doesn't always have the latest, greatest data you need. So you got to sort of expand your world beyond that.
Mike, what does SPI use? I mean, I know you guys have sometimes
we have a lot of the paid service, but I mean, we're in the markets that we own in. So I think we have a lot of this kind of day-to-day travel knowledge. But, one of the biggest things that we are concerned about is crime. So, I think it's crimereports.com and then greatschools.org.
Yeah, I was going to bring that up. Yeah, the schools is the biggest thing.
People just want to live where they, near employment centers, near retail, near major thoroughfares. But if you have a property, particularly with like a bunch of 2-bed and 3-bed units, those are tend to be more families than there are singles. So, the more that is it's more important to have, better schools and no one really likes to live in a place where the cars get broken in or they might get robbed in the parking lot by some junkie. So crime stats and reports are a big thing so those are some two resources that come off the top of my head, Paul, especially if you're unfamiliar with the area. And then when we're looking at schools, I focus a little bit more on the elementary than I do the middle or high school. Because, if you think about the elementary is a little bit more of the neighborhood thing where, junior high schools have multiple elementary schools feed into them and high schools, tend to have larger and larger enrollments where the elementary school is a little bit more local to that specific location, I guess.
Makes sense. Anything more on that one?
Yeah, I think you also want to pay attention to median incomes in the neighborhood. You want to pay attention to things like job growth numbers in the neighborhood, population growth. Those are some of the fundamental metrics, not just on a city level, but on a micro market level where you want to know, hey, look, can these people afford, to live in the area that we've got, right? I mean, if somebody's making $20,000 a year, are they really going to be able to afford $1,000 a month rent, right? And most likely the answer is no, they can't, right? So you got to know these things.
One of the things I know that SPI does, I think, Mike, you've talked about it before, is taking a look at the cost of the rooftops in and around the
I don't want to spend $100,000 a unit on a Class B apartment complex if the average median house next door to me is $150,000. Because the mortgage equivalent rent is, kind of out of whack, meaning that you pretty much just pay for a mortgage for the same price you're going to pay for the rent on my property if we're kind of generally in that type of range. So, if I'm buying a property for $100,000, the average median house is $200,000 or $250,000, that same mortgage equivalent will be materially higher than what I charge for my rent. So there's got to be, a pretty decent gap in between those two things. And like JC says, you got to look at your demographics of 1, 3, and 5 mile kind of radius, and the 1 and 3 being more important. And if it takes, we typically have 3 times is kind of the minimum qualifier. So if you have $1,000 rent, they need to make $3,000 a month or $36,000 a year, and then that's the average of the whole area. So you probably want to have $45,000, $50,000 in that area to be able to feel comfortable. You have enough people that can afford $1,000 a month. And if you're at 36,000, that you need, and you're at 40,000, there's really not a whole lot of gap there either, Paul. So I'd be a little bit more cautious that there's just enough people in that area that can afford what your pro forma rents are.
All right. The one thing I want to focus on, the last little nugget, and I think this was a good one, on operational management, actually operating the property. And I want to kind of talk a little bit about lead retention or retaining the current tenant and what it costs to change out tenants.
Yeah, I mean, it's a great topic. A lot of professional third-party management companies are going to be very aware of this, but I sat in a room with an interesting presentation where a guy had done the math, and basically he said, look, every time a resident moves out, it costs me money, but I really never knew how much it cost me, because it's not just the cost to turn the unit. It's basically the number of days it sits vacant. It's the labor of the people that could be doing other stuff for the property that have to focus on turning another unit, make ready, turnover. It's the advertising that you're doing. So you put all this stuff together. He did the math. He said for a unit that rents for an average of between $700 to $800 to $900 a month, the total cost for a person leaving is $4,800 per unit.
Wow.
$4,800 a unit. And it makes sense, because I've sort of been on this in our portfolio for a while. And for him to put that number together really made a lot of sense to me. And so what that means effectively is that for every person that you can stop from moving out, you're saving yourself $4,800. So if he gave an example of a property where he was able to take the retention from about 30% up to about 50%. So you figure that's 20% retention. Well, if it's a 100-unit building, that's basically, let's say 20 units. 20 units times, let's say $5,000 a unit. You're talking about a huge savings in terms of what would go out the door. So this is big money that you're leaving on the table if your retention is not where it should be. And if you can improve that retention, it's definitely better than putting new butts in the seats, meaning I love it. My operational person always tells me, "Hey, JC, look, I appreciate that you want to put new people in the front door, but I got to also make sure, more importantly, that I close the back door. See, if I got people leaving out the back door because our service isn't up to par, it doesn't do me any good because that's costing me more money than what I'm putting new butts in the seats."
Talk a little bit about that, because that's something we don't do a better job on, dealing with prospective tenants. And say that person walks into your leasing office, what type of feedback should that person get?
Well, I mean, when a person walks into a leasing office, typically they're going to be focused on, simple things like, did you hand them a cup of water when they walked in? Did you make them feel like a human, or did you make them feel like another number, now serving number 67, right? Mm-hmm. The other thing is that, people want to envision themselves living there in a lifestyle. So it's not necessarily just about, I've got a unit that's going to rent for $750 or $900 or $1,000. It's about, what am I going to feel here? Do I feel like it's a home? Is it safe? Do I feel like I can live in the neighborhood? Do I feel like I have to be careful at night? When I walk into the leasing office, is it clean? Does it have a nice modern feel, or does it look like it's stuck in the 1970s? So it's not just about the unit upgrades, it's about the experience at the property, and that's what the residents look for.
And how about the touch? I mean, when should you touch that person again? Within 24 hours, within 1 hour,
so I mean, when leads,
10 minutes?
these days, there was another conference I was at, and it was really interesting. So the person made the point that, which is absolutely true, is that in the today's day, people want instantaneous response. So when a lead comes in for your property, within 5 minutes, if you don't call them back, the chances of actually converting that person to a lease go down significantly. And so that's sort of your level one, is you get a hold of them within 5 minutes, right? And you think about it, they're probably within the first 5 minutes, they're looking at 17 other properties and they're texting or emailing 17 other properties around you, or 2 or 3. So if you can get to them right away and set an appointment, you're going to have a much better chance if you let them go another 10 minutes of looking at other competing properties, right? And then the next level is you follow up within 1 hour. If you follow up within 1 hour, you still have a really good chance of converting that person, but not as good as the first 5 minutes. Now, if you wait for 24 hours, your chances go down very significantly. So if you're only following up within 24 hours on a lead, your chance to close that resident or make them a resident is extremely low. And after 24 hours, they're basically not good leads. That's how quickly these leads die in terms of a person wanting to say, I'm interested in checking out your property, to the time that they go, no, sorry, no thanks, you'll never hear from them again.
You touch them by just a text or an email?
Which you need to pick up the phone, and texting is great. I like to text first and say, hey, can you chat for a second? And have them call you back, because people don't always answer the phone. And I think leaving voicemails is not a good thing, because today nobody checks voicemails, right? Everybody responds by text. So you try to get them in the first 5 minutes, send them a quick text, say, hey, we got your interest. Can you give me a call to chat? It doesn't need to be too long or too overly formal. Mm-hmm. It's more of an informal text. Get them on the phone, and from there, book an appointment.
Let's go over to the conference that you and Mike were just at. Tell us a little bit about that conference. Mike, how many people were there? What did you talk about? You were on stage
I'm
talking to a bunch of people.
So I'm just assuming JC started off good and probably went downhill from there. Is that right?
Yeah, a little bit, because Mike kind of capped it off at 7:45 on a Tuesday, and after that, it was you couldn't top that from there.
Yeah, so I was initially I agreed to be on a panel, and I got busy, didn't pay attention. Then I get an email, looked at it, I was like, oh, when is that conference again? I need to show up, and realized I was kind of leading a roundtable discussion. It was at 7:45 a.m. where they're registering and having breakfast. So I was a little initially ticked off, and then thought there'd be like 3 people in the room. But turned out there's probably like 65, 70 people in the room that I was in. It was actually pretty good roundtable discussion. And they had a bunch of stuff after it, which unfortunately I was unable to attend. So I don't know how many people you think were there. 400 or 500?
There was a lot. I'd say about 400 or 500 people.
Yeah. So it was I went to one of these in Orlando in late 2017, I think it was. So they the company's IMN, and they do all sorts of conferences for different topics all over the country. So that's kind of basically a seminar business, essentially, Paul. But I think they did a pretty good job here. I think it's the first time they did it here in Texas, in Dallas-Fort Worth, and a lot of people that I recognize from local, and then there's a lot of people from all over there as well, which I think makes sense because we're in the middle of the country, so people from both coasts and
was
all
there
over.
any questions that came out of your little round table you thought were interesting?
You know what? I referenced it a little bit earlier. One of the younger, well, not say younger, but the less experienced guys, he owned a couple hundred units or something like that over like 4 or 5 deals. So kind of some smaller multifamily here in Dallas-Fort Worth. I think he's where he was owning. He mentioned that he was frustrated and can't find more stuff. And that was kind of my point earlier when JC was talking about Smith Creek. I mean, my response to him was you got to do more. Whatever you're doing, you're not doing enough of. And then you got to reflect a little bit more on what you're doing and try to really just double down on the stuff that's effective and kind of get rid of the stuff that's ineffective and kind of the actions. But really the roundtable I talked about was really, the topic was kind of scaling your business from, a small time player to mid-size or larger company. So we were just kind of really talking about some stuff you could do to eventually just kind of scale up, both from management, but more kind of raising capital and buying more properties. That's really kind of what we talked about. And had a bunch of other topics too, JC. What nuggets do you take away, Paul? You had some notes from our pre-meeting we had.
Lower yield environment.
That's a good one. So, I with these conferences, right, you tend to get millions of data points on things. So I tend to try to go with big themes, things that I hear over and over again over multiple sessions. And one of the things that I heard for sure was that we are in a lower yield environment, and it's kind of here to stay. And the case was made over several different people that multifamily as an asset class, if you look at the holistic level, stocks, bonds, cash, alternative investments is being perceived right now as a very good, safe place to put some of your money. And so there's definitely a significant allocation of the general investable assets going into multifamily, and that's going to continue to be the case. And so although we've sort of seen this cycle of sort of all-time highs for pricing, there's still so much more pressure coming in from the capital side to park their money in some of these a little bit more safe havens, that you're going to continue to see the pricing stay at these lows, or I should say at these highs. And so therefore yields are going to continue to be compressed. And so the idea of resetting the investors' expectations, if you're working with capital partners, which we all do, it's not just about whether we can, go out and secure a great deal. It's also about making sure that we educate our capital partners on the reality of today's market in terms of what they're going to make on a cash-on-cash perspective, and also on an equity exit on the backside with these deals. If you got a lot of people, a lot of capital chasing these deals, then you're going to keep the pricing high and the yields are going to be low. And so if investors that you're working with have a mismatch between maybe what they might have made even on deals that they were in 2 years ago versus where they're at today, you're really going to have a lot of trouble with these investors and sort of what you're going to be delivering on reality versus where they're thinking they're going to get. And so the better job that you do of resetting expectations on what today's market will bear, just the better off you're going to be as both an investor and also as a person that's putting these deals together.
I think that's an excellent point. Setting expectations correctly is probably the biggest thing. And then talking about that, and it's probably our final deal point, is the cost of the institutional capital getting more expensive.
Yeah, it was another big theme that I heard from several people is that, institutional capital, as everybody should know, is one way to go after, and scale your business up, right? I mean, you go after institutional money, and these are big dollars. They write big checks. You get to work with just one partner instead of maybe 50 to 100. But the downside with these institutional partners is that they take a pretty significant piece of the pie, a lot more of the pie than, say, if you're working with like high net worth individuals or even family offices. So the point that was made over several discussions was, hey, look, institutional money is okay, but we're gonna really focus on high net worth individuals and go raise money there, because it enables us to make the deal more equitable for both sides, both the investors and for the the sponsors or the syndication companies. And so what's happening is that these institutional partners are sort of being left out of what I would say to be more and more deals. And so what's happening is they're turning around and saying, okay, well, we're going to move down the food chain too, and we're going to start looking at, so now you hear about institutional investors going into value add, even B space stuff, where, way back when institutional guys were basically A stuff. That's all they did. Mm-hmm. So because of the challenge of the institutional guys finding people that want to continue to place deals with them, and also the challenge of them having a lot more capital, they're dipping lower and lower into the asset stack. And that all puts together the fact that, number one, if you're doing deals, you got to do more volume with these guys, institutional guys, to make it make sense. But also it means that the institutional guys are moving down the stack in order to actually find more deal flow so they can continue to place their capital in these markets.
Yeah, institutional guys are not going to be your capital source in your first or second or even fourth or fifth deal. They may be an option, on your fifth, sixth, seventh deal that you've had success, that you've actually entered into a transaction, you've acquired it, rehabbed it, stabilized it, and sold the property, and you can show a track record of doing it. Institutional people are not going to be your savior to come in to do 100 or 150 unit property. They just won't. So, I've seen institutional people stepping down into this C space or so, trying to get higher yields. So let's say out of a $15 million raise, they may come in and bring in $10 million out of the $15 million that's necessary. So you raise $5 million from your friends and family, and then they'll bring in the $10 million. Now, it's not cheap. I mean, it is. They may ask you to do an 8% current pay, which means that you got to pay that on a monthly basis, and they may accrue 3.5% on top of that. So that's accruing every month, every year that continues to kind of dig that hole, and they may charge you 2-3% to just do it. But it's on $10 million, so it can be very expensive to do it. But our best advice in this space is, banging out with friends and family. When we say high net worth, that always puts in my mind is, J.P. Morgan, the guy with the white mustache and the black hat, kind of saying that, that to me is high net worth. But some of these guys are just high net worth. They're engineers or doctors or guys that work in the marketing department that are making, $250,000, $300,000 a year with, joint income that may have $2 million or $3 million in net worth. That those are the guys that you're looking to talk to. And just like what you were saying before, create some of those little educational videos that kind of highlights you and makes you a thought leader in that space. But don't try to use those videos to try to sell a specific deal or any deal. Just be an educator. Anything more that you learned from that most recent conference, JC?
Yeah, I think that the other piece that we don't talk about, which is sort of the intangible piece, is, there were several people that I met at the event that I wanted to meet, that I was able to meet, and several more that I didn't know existed that I was able to meet. And I took away a couple of real solid leads on relationships that could be beneficial for them and also potentially beneficial for us. So I'd say that, most importantly, when you get out to these events, take your opportunity to walk up to people that you don't know. And you never know what you may find out, but make the relationships, create the opportunity to network, and things just happen from there, which you would have never thought.
So one of the things that we do is we partner with JC out in Northern California with Brad Sumrock on the Apartment Investor Network out in Northern California. One of the things we're going to change that up a little bit starting, I think, next month or so. So look for an email to go out, and at the end here, we'll give you JC's name to get onto the list itself. So we're going to do a Zoom broadcast, and some people have seen they're kind of like webinars. They're kind of live webinars. So we'll have a guest speaker talking a little bit about what's going on, and he'll be in someplace X. And instead of having one location in Northern California, we wanted to open up to everybody in the nation just to kind of see a little bit about what's going on with one of our events up in Northern California. So instead of having 60, 70 people, we're hoping to have 600 or 700 people to listen and participate in a Zoom educational event about what's going on in multifamily up in Northern California, but investing in other parts of the United States. Anything more to add to that, JC?
Yeah, it's a great point, Paul. I mean, you and I talked about it, right? I mean, the Apartment Investor Network, again, if people want to go become a member of the Apartment Investor Network, it's absolutely free. You go to Facebook. We've got a Facebook page. You go Facebook at Apartment Investor Network. You'll find us. Go ahead and follow us, like us. And the idea with this group is that we want to expand the audience of just the California folks, because we've actually got quite a number of people that have already liked and wanted to come to the meetings. So this virtual idea, the idea of hosting these virtual meetings is going to be great, because we can open this up to anybody that's got an internet connection. They come in because we've got great speakers, we've got great content, and we're going to actually expand it just beyond California. We're going to give people the opportunity to come in coast to coast. And like Paul said, instead of only giving 60 people the opportunity to hear these great speakers and great education, we want to give the opportunity to 600 people to have that educational experience.
Absolutely. So, JC, can you give them your email address and the website address? Absolutely.
So if you want to contact me, you go to our website, multifamilypropertygroup.com. You go to the Contact Us page. You just get a hold of me if you like. If you want to get a hold of me personally, my email address is jc@multifamgroup.com. That's JC, like initials, JC @multifamgroup.com.
Mike, anything more to add?
I appreciate you coming in, JC. Always good to see you, buddy.
Thanks, man. Thanks for having me, both of you.
All right, Michael Becker, smartest guy in the room. Second smartest guy, JC Castillo. I'm not even the
You stack breaking. It was good.
All right. Thanks, guys. We appreciate it.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.